Hello, welcome back. Today we'll talk about Dyna-Mac. It is not a company that many are familiar with and study in detail. The share price crashed and was sluggish for many years when its revenue dropped badly and was in bad shape. However, the share price has been up more than 50% year to date. Revenue for this year will exceed its previous high in 2014. Is this real? Is this sustainable? I believe that Dyna-Mac is a high quality stock with a good potential for more upside. Let's dive into details and discover why Dyna-Mac is a hidden gem. Before we dive in further, a quick reminder. A quick intro about Dyna-Mac. Dyna-Mac specializes in fabrication of topside modules for FPSO and other offshore floating platforms. It has 2 yards in Singapore. Their customers are large international players who own and operate the floating units. A brief history of Dyna-Mac. Dyna-Mac fortune is closely tied to the oil price. Dyna-Mac was IPO in 2011. The company was doing very well when the oil price was at a high. From the high, oil price dropped by about 50% in 2014 to about 40 to 60 range. Dyna-Mac revenue peaked in 2014 and plunged almost 90% by 2017. Net losses were more than its revenue. Dyna-Mac was badly affected during the period. Sadly, in October 2019, its executive chairman, largest shareholders and CEO Desmond Lim died of cardiac failure. In March 2020, Mr. Lim R. Cheng, not related, was appointed as CEO just when COVID was starting. However, since then, revenue has been growing very well. Revenue this year will exceed the peak revenue in 2014. Zooming into their recent quarterly financial numbers, revenue has been growing very well with its profit. Let's add another perspective. During the last oil boom, its cash position was declining while revenue grew. When revenue peaked in 2014, its net cash was negative. This is bad. It got worse when its revenue plunged into losses. Its shareholders' fund took a big hit. However, this time as revenue grew, cash position grew significantly to levels not seen previously. This should be the case. It is doing much better than the last oil boom. They have learned their lesson well. In the last oil rally, the margin were much higher. Now, the margin has been low, but they have been inching up nicely in recent quarter. Its net order book has been increasing quite significantly. They are winning more contracts faster than they can deliver. This is a happy problem. They need to expand to deliver, which they are doing now. Or else their order pile up too much, take too long to deliver, and customer may choose to go elsewhere. Dyna-Mac has been announcing various expansion and strategic initiatives. They are also exploring ways to expand without incurring too much capex, such as working with King Heng to deal with demand spikes. They are trying to balance growth by being more efficient with less capital. They want to diversify for more sustainable and less cyclical growth. All these are good. They are hitting all the right notes with all these initiatives. We have to monitor to ensure they do what they say. This is taken from a very recent presentation by Citrum at Morgan Stanley Asia Pacific Summit, where they presented on industry tailwinds. There's a lot of new contracts for FPSOs. New segments such as CCUS as well as marine decarbonizations are areas that Dyna-Mac can extend into given its existing capability. They themselves are also making plans. So there are long-term opportunity and potential awaiting Dyna-Mac. In summary, Dyna-Mac has been turning around very well with its net order book, revenue growth, margin expansion, growing free cash flow, and strong cash position. They are doing right. Their strategy and plans shows their intention to pivot to make themselves more sustainable and less cyclical. They are doing the right thing to ensure that they survive well to strive in the longer term. Well and good, we just have to continue to watch their progress. Here's a list of SGX listed oil and gas companies. These are the survivors. Quite a few did not. Many still have high debts such as Mancast, Namchong, Atlantic Navigation. It is a cause of surviving through the crash. MTQ and Mancast became smaller. Their revenue reduced significantly. I've examined each of them and I found Dyna-Mac to be in a better shape and doing much better. The other good stock is Marco Polo Marine, which I will cover in another video. Only 2 brokers are active in covering the stock. Their reports are quite comprehensive and give Dyna-Mac a price target of about 50 cents. With share price of 29 cents, its market cap is 306 million. Trailing 12-month PE is 14.9 times. Valuation is attractive. Analyst target of 50 cents is achievable. This gives an upside of 72%. Market is not familiar or interested in Dyna-Mac. This could be due to its small market cap and cyclical oil and gas business. Dyna-Mac need to keep growing to surprise the market and for investors to take notice. We need to be patient. One important thing to pay attention to is the stability of the oil price. The reason why the stock price has been sluggish could be due to Dyna-Mac not releasing quarterly updates. So there's no Q3 updates. Not releasing quarterly updates is seen as investor unfriendly. More frequent reporting provides good insight to investor. Well, we just have to wait patiently for the full year result expected in February next year. Here is the weekly chart since listing. The recent top was 44.5 cents before it went into a downtrend. Next support is 27 to 25 cents. At 25 cents, the trailing 12-month PE is 12.8 times. The weekly MACD is at a low. Invested. This is one of my larger SGX position. I will add if it goes lower to the support level. This is all I have for Dyna-Mac. I hope you find this useful. Do give a like and subscribe to the channel for more such content. Thank you.